Welcome back. Still with me in the studio, Graham Smale, Director of Interest Rate Products on the JSE, and from our bureau in Cape Town, Wikus Furstenberg, Portfolio Manager at Futuregrowth. We were talking before the break about companies issuing bonds as well. I wasn't aware that. I was under the impression it was only governments that issued bonds.
No, at the end of the day, a bond is an instrument whereby somebody is borrowing money. So in principle, your day-to-day life where you have a bond on a house, you're financing your car or your hi-fi, you're going through the same kind of economic transaction. You're getting money from somebody, so you're the borrower, and you promise to pay it back. The structure of a personal loan or a home loan is slightly different from the way the bond market works, but the economics broadly are exactly the same. So any organization that has the need for capital can raise it in one of many ways. The standardized way is you go and borrow equity, so we're now talking about companies. The government is not able to do that. Or in the corporate finance toolbox, you can also use then raise debt. So you can go to a bank and borrow money, just like we was an individual. You can do trade finance, in other words, you can borrow money against some of the receivables that you're getting as a company, or more and more the bigger companies are coming directly to the marketplace and using the same instrument a government has done for all these years as what's called a vanilla bond. They would be borrowing from the marketplace, and they would be, as a company, expected to pay a premium relative to a government. Because in the world of bonds, historically, a well-run government is considered to be the risk-free environment where you earn the lowest rate, but you have the highest safety. And a company always has the probability of going bankrupt, and therefore it would be expected to pay a premium over what the government would pay in order to get the money from you as an investor.
How, Wikus, you may be able to answer this question. How big is this bond market? What sort of money are we looking How much money has been invested into the bond market? Is it a big chunk?
Jeremy, is quite big. I mean, Graham might be in a better position to give numbers, but I mean, at last count, I thought the total market size in South Africa was about 1.4 trillion rand, of which government owns about 60%, just over 800 billion. Just to maybe put that in perspective, if you convert that to US dollars, that will give you about, at today's exchange rate, rand-dollar exchange rate, about $200 billion. Now, let's compare that to the US market, only the US Treasury market, which is, in terms of outstanding debt, size of that, it's about $14 trillion. So, although South Africa is quite big in terms of that on the African continent, it's certainly quite small in terms of, you know, the more developed markets like the US, Europe, etc., etc. But nonetheless, even with that, our market is fairly sophisticated. And you mentioned corporate debt. It's a fair chunk of that. And clearly on our side, it's a very, very important tool to use in generating excess return in our bond portfolios. But clearly you have to be very careful how you go about. That's why we employ analysts to take views on those that we're prepared to lend money to, ensure that we pay the appropriate yield. And as Graham mentioned again, you would expect them all to trade at a premium relative to government. And then again, it gets even more complicated. I mean, I don't want to name names here in terms of issuers in the market at the moment, but some of them obviously will have a higher risk of default than others. Now, the higher the risk of default to those you lend, the higher the interest rate you would expect them to pay to us, the lenders.
Do the JSE have a form of education around this particular aspect? Because it seems to me to be very technical.
It is, yet I think at some of the base principles it is not that complicated. The JSE certainly has a very strong retail mindset and education mindset, but they haven't extended that into the debt area, and it's certainly something we should definitely be looking to. One of the challenges we have is that as a retail investor in equities, there's a very clear path for you to get hold of a broker, to talk about the shares in the marketplace, and then be able to execute a transaction with the pot of capital that you have available. In the debt market, it's a little bit more complicated, as I said, to start it off, because ours tends to be the wholesale market. In terms of relative size, our overall listed equity market is just over 6 trillion. Our bond market is sort of 1.1, 1.2, depending which numbers you look at. So it's about 1/5 to 1/4 the size. But if you look at the size of transactions in our bond market, the average size in the equity market is around about 125,000 Rand per transaction that happens. In our market, it's around about 25 million. So it just gives you a feeling of that it's a big boys game. And where that money comes from is from pension funds who have a need to invest in bonds as part of their portfolio structure, and then bond funds who collectively bring investors together and invest in the bond market. So it's certainly, I take your point, and programs such as this have highlighted the ongoing importance of bonds to the retail investor, particularly given the volatility in equity markets we've seen over the last couple of years, that bonds can form a very important part of cash flow management, and then also stability of value of a portfolio. A couple of key points that were brought up at the start of the program.
Because just to get back to the company bonds that are issued, I know that you said there is a bit more risk there. Why would you want to take my hard-earned money and put it into a risk position? Is there some sort of inflation-linked return on this, or are we just now going a little bit risky on a thing that shouldn't really be risky, as in a bond?
Jeremy, is all relative, because at the end of the day, you know, we invest a fair chunk of the money we're managing in corporate debt, or you know, lending money to the corporates that you refer. And you know, what we try to do is we try to find a balance between investing that money at an appropriate yield in order to squeeze the best possible return for our clients. Now, we need to take into account the risk return profile. So if you want to sort of earn, the more you want to earn, the more risk you need to take. But I think it's very, very important here to note that we're managing that risk, and that's invest people that will actually go and look at income statements, balance sheets, etc., and not rely on official rating agencies. We need to be well ahead of official rating agencies, because, I mean, in the past they tended to be behind the curve, quite frankly. And I think we've been quite successful, and there are other asset managers who are also doing it, and they've been quite successful in sort of doing that risk management on behalf of our client. To keep in mind as well, most of those corporates that are prepared to borrow money in the bond market are also using the equity market. So if you're prepared to buy equities from the same issuer, you should really consider buying bonds from them as well, because at the end of the day, if something happens to that borrower, that corporate, i.e., you know, it's closing doors, etc., then as a bond holder, you've got a better chance getting something back than the people who invested in the equity issued by the same corporate.
Now that's an interesting point, because just in some of the research that my producer Natasha Jacobs passed on to me, the one thing that came through was that if you bought equity in a company and they go bang, as a shareholder you're last in line.
Correct.
But if you hold a bond in a company, you're the first in line.
Yeah, there is a tiering. It's what's called a waterfall. So you generally, trade creditors tend to be the first in line, and then even in the bond sector, when you buy a bond, you could have two bonds from the same issuer, but one might be in the queue before the other. So one is what's called senior secured, and the other may be junior unsecured. So it does get complicated, but in principle, you sit in a queue and definitely before equity investors.
Does the JSE vet these people? If I come along and I say, I'm here representing CNBC Africa and I want to issue a bond because we need money to pay our presenters because they're all demanding huge salary increases. And I approach you. Does the JSE vet me first?
The JSE itself is not an arbiter of value. In other words, what it doesn't say is what this thing should be worth. What it does do is sets a set of minimum standards in terms of disclosure between you and the ultimate buyer. So what we would do is say you need to have disclosed this information, this financial history, you need to have this kind of track record, and when you talk to investors you need to display in this kind of information in the public domain. So what that then does is forces a minimum standard of disclosure, and ultimately it's willing buyer, willing seller. So you will take your story to an investor, you will be at least asked to disclose the information the exchange puts in place, and then the investor will be looking at your story combined with that set of information and ultimately setting the price they think is fair.
And that's, Wikus, where you would come in and start drilling down into CNBC's books and saying, right, we expect a return of X% on this particular bond, I take it.
Absolutely, Jeremy, and I think we will obviously take it even because at the end of the day there are legals that need to be covered as well. Because what we need to do is we need to ensure that we actually, in a worst case scenario, will get back as much of the capital that we've invested in CNBC Africa, for instance.
Guys, thank you very much for your time. Once again, we've run out of time. It always tends to catch up with us, and we can't touch on as much as we would like to. But very interesting conversation, and I think the end result is really speak to your financial advisor or your broker and start looking, especially if you are getting a little on in age, and start looking at maybe moving out of equities and into bonds, so you've got the cash flow coming in.
Correct.